How are distributions from a limited partnership position in apartment syndication taxed? I love these that seem like they're really simple, and then I've actually, I did the dance with somebody on this not so long ago. What they did is they had you're a limited partner, which means you're not participating and you're not at risk. What happens in a lot of apartment syndications is they say, hey, you put in $100,000 and we're going to give you back not just your $100,000 within a year, we're going to give you that plus a bunch of money, and we're not going to have any income. Yeah, figure that one out. What they do is they go fix up the apartment, they refi it, and then they distribute a bunch of that cash. If you've done that, you always get your money back tax-free. So whenever so the way it works is I have a capital account. So if I put money into a syndication, I can always get that money back tax-free.
Right.
If I get a loss, then I'm limited, because I'm a limited partner, unless I'm at risk. So I can't use a lot of that loss. If I have income, it doesn't matter what I have going on, I have to pay tax on that income if it's issuing me a K-1 with income on it. If it gives me back more cash than I put in, and I don't have basis, I don't have risk, then I have to call that long-term capital gains. This is what's bizarre. So again, what a typical situation is, a promoter of apartments says, hey, we're going to fix this apartment up, and we need $500,000 from the investment pool. We have financing on the rest, and we're going to get a whole bunch of cash out of this thing right after we fixed it. It's the buy, rehab, rent, refi model, the Burr model, and then you take the money and you go do it again. Well, the way they take the money out is they issue it to the owners. And if you put in 100 and you got back 150, you're going to pay tax on that 50, even if there's no income from it, even if the depreciation is keeping there from being any reportable income.
Right.
So that's how it is. So something that looks so easy from an accounting standpoint can be an absolute kick in the shin. But
you got an extra 50 out of it.
Yeah. It's like, hey, can't be mad. Let's see. If you pay all estimated taxes due before the year end, fine-tuned for the year's earning, will there be a penalty if you do not pay quarterly estimated taxes? So you pay all of your taxes before the end of the year, but you didn't pay your quarterlies. You're still going to have underpayment.
You're going to have what's called the estimated tax penalty, because IRS wants you to pay this money in quarterly. Now, there are a few ways to get around this. Say you made your estimates December 31st or December 15th, but you earned all your money. You made a huge profit in December. What we can do is actually annualize your estimated taxes. That is saying that most of your income was earned during a specific period, so the tax was due during that period instead of back in early in the year. So that's one way to kind of alleviate this estimated tax penalty.
This is why you hire an accountant. Yeah, that is funny. Hey, we have one that's still related to that LP. Somebody received a K-1, and this is interesting. It has to do with the 199A deduction, and they just had a note on their K-1 that said this property is under triple net lease agreement. It does not meet the definition of qualified trade or business under IRC Reg 1.199A-B14. Does that mean I don't get the 20% QBI deduction or something else? No, it means exactly that. It doesn't qualify as qualified business income, and that's the only type of rental activity that does not, is triple net leases on commercial property. So if you get that through your LP, then you're not going to get that 20% deduction. Otherwise, you possibly can. So it's kind of weird. In an LP, I guess, they're completely passive.
Yeah,
you still get it.
Right. Because it has that real estate factor.
Yep.